Ladies and gentlemen, a very warm welcome to the VIP Industries Limited Q2 FY23 earnings conference call. From the senior management, we have with us today Mr. Anindya Datta, Managing Director, and Ms. Neetu Kashiramka, Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anindya Datta, Managing Director of VIP Industries Limited. Thank you, and over to you, sir.
Thank you. Good evening, everyone. Thank you for taking out time for this earnings call late in the evening. And at the outset, apologies for a late upload of the presentation as well as the results. We just about finished the board meeting, and that caused the delay. However, I'm hoping that you would like the presentation that we sent across to you. It's more detailed than what we've shared in the past. Having said that, I think it's quite a delightful moment to announce a really good set of results for Q2. This is somewhat what I think the whole organization is working towards. This may be one of the milestones that we wanted to achieve in terms of the all-round result that the organization has been able to put forward. We saw revenue grow about 56% year on year. Why is year on year important now? Because somewhere from Q2 last year, things have started to normalize. However, even if you were to look at it from the base year point of view, which is FY20, the growth rate for the quarter has been 25%. The flow through of the revenue with a healthy gross profit at about 48%. Has been down the line through a good fixed cost management, has had a good profit, resulting profit as well, with a PBT at about 10% and an EBITDA at 14.8%. All key metrics that we see has gone through a very positive uptick as far as the quarter performance is concerned. If we were to talk a little bit detail on the revenue, and as you will see in the presentation shared, I think all channels and equally brands and categories have worked very, very well. General trade and all the physical channels, general trade, retail, and modern trade has done extremely well, as e-commerce also. Specifically talking about some of the key shifts that has happened at channel level, I think what we were pursuing in terms of increasing our retail outlets, our exclusive retail outlets in the market has really worked for us. As of Q2, we were still lower than the corresponding quarter in FY20 in terms of total number of retail outlets. However, the total revenue in retail has seen a growth, which means that per store throughput has been extremely good. I just wanted to share some numbers with all of you. We are today at about 413 stores operational end of Q2, and we have almost about 45 odd in fit outs. So that takes the tally to about 458. We should definitely have this number to be more than 500 by the end of the year. The same number was about 485 exclusive stores in the corresponding quarter in FY20. The mix is quite different. We have majority of this new stores that we are reopening or opening after where we are reached in terms of the lowest was about 365 stores. All the new stores are franchisee stores. Majority of them are franchisee stores. The other highlight I think worth mentioning here is modern trade. Modern trade, we had a big, I would call a headwind in terms of Future Group not active, and in terms of the 432 odd stores they had, even in Q2 only a fraction of that was operational. I think we've done a great job in making sure that the demand that was lost because of the Future Group shutdown has been caught very well in all the other modern trade chain stores, as well as in retail or in MBOs in the same catchment area. And from our internal estimates, modern trade has surpassed the budget and the internal estimates that we had for the quarter, and which it has resulted in a growth despite this of about 22% over the base year. So both, likewise, all channels have done extremely well, able to leverage the buying season. Usually quarter two is almost one-third the annual sale in e-commerce because of the big properties that are there in quarter two, big days and festive buying. We've done very well there and have done a significant. The growth numbers are almost double of the base year as of this year, quarter two. I think the one more key highlight here worth mentioning is, international business. We've been pursuing it, not in a big mega strategy, but to make sure that, where we were present and in geographies where we could get a inroad, we've started to get that. Middle East has worked very well for us, as well as, several about new countries, about 7, 8 that we have been able to open in H1. The international business in first half of the year stands at 5% of the total business. This was about 2.5% in the pre-COVID era. When I talk about brands and categories, I think both the big news there, or heartening news rather, there is while value and Aristocrat has been on a run, the premium and mid-premium brands, Skybags, VIP, and Carlton has joined in, and in quarter two, it was very heartening to see all these, all the three brands growing on the base numbers of FY20. So not only our strength, our renewed strength in value, but I think our past strength in the mid-premium segment has come back in its full play as far as Q2 is concerned. So with that good set of revenues, and I think as I spoke about our supply chain strategy, our own manufacturing strategy, and our cost controls have resulted in the profit that you are seeing on the results that we have announced. So by and large, a good quarter, and really looking forward to even possibly a better one with much more in terms of consumer impact activities coming out from that you would see in the coming quarter. And the presentation that we have sent across gives some sneak preview of what we are about to launch for our consumers in quarter three. So quite positive about how we see the future from here onwards for the rest of the year. Thank you from the opening remark point of view, and any questions, please.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question on the line of Tejas Shah from Spark Capital. Please go ahead.
Thanks, Bob. My first question pertains to your read on the demand environment in general.
Tejas, your voice is breaking up in the call. If you could kindly come on the headset mode once.
Yeah, is this better?
Yeah, this is better.
Yeah, thanks a lot. Yeah, so hi. My first question pertains to demand environment in general, your read on the same. As in, we have seen a lot of categories like ours where there was an element of pent-up demand which was very much loud in the second half of the last year and even first quarter of this year. So are we seeing the pent-up part still playing out, or you are seeing that the recovery, what we are seeing now is more of a sustainable one, and the pent-up element is actually receding in this phase now?
Hi, Tejas. So I think it's a mix of both, and somewhere it is more middling out. There is a bit of pent-up that we are experiencing. However, a large part of this could be sustained. And where I'm coming from in this is definitely the unorganized sector into organized seems like could sustain at least for a much longer period unless something very differently evolves as far as the unorganized sector is concerned. So that's working differently in our sector than any other sector. Generally travel and the whole buoyancy on spending and, the marriage season is ahead of us in the next half of the year. So I think quite hopeful and quite optimistic about the demand environment to sustain the way we are seeing right now.
Sure. Second, on your presentation, first of all, congrats on and thanks also for a very detailed presentation. In fact, quarter on quarter, we are improving on disclosure levels. One theme which one can't miss out is premiumization, which is very much clear on most of the slides. So if you can elaborate, what are we doing exactly on this? And when we are talking about premiumization, somehow Carlton is actually not much has got slide space. So just wanted to understand how are we going about the whole portfolio premiumization and all the premiumization initiatives in the existing brands also.
Right. No, Tejas, I don't think we should measure it from the slide share point of view in terms of how many slides what is got. But really, premiumization is something that we've been driving. One thing the starting point is that this is something that we were strong at. It is not a new strength. Value is a new strength, and I think we are doing pretty well there. We started to do pretty well. In terms of premiumization, both from a consumer, activation in terms of Asian and, communication and promotions, all that, if you were to look through the presentation and otherwise, that's most visible. If you go to our stores, you would see all the new launches in VIP and Skyback. There is certain themes that we are working on, which are extremely premium or adding consumer value themes, and more products are coming there. In terms of advertising, Skyback is taking it to the next level in terms of how we are connecting with the Gen Z. And also, if you see the whole retail strategy, and I spoke in detail about how we are expanding our exclusive business outlet network, that is also something that is adding hugely to be able to sell that experience to the consumers as well as therefore sell more premium products. So it's a 360 degree around this in terms of driving the mid-premium and the premium agenda, and it is something that was there and will come back, will continue to be there, and in fact get strengthened going forward.
Sure. And VIP Highlander, is this just a collection, or we have launched a flanking brand along with the mother brand there?
The Highlander, every product has a name, so in the presentation it is there, but it's not going to be something that will be advertised to the consumer. It's a VIP product. It is designed, with an SUV in mind. So in a way, this is the rugged-looking, macho-looking bag that you would like to believe that taking it with you enhances the image that you would want to portray. So that's the theme behind what VIP wanted to bring to the consumer, and it's, as we call it, it's the all-terrain luggage. And if you see every component of that, whether the handles, whether the wheels, and whether the whole composition has built to sustain more, tougher environment and a tougher terrain, as they are calling it.
Great.
So it's not a new brand launch, stages. It is a VIP
new range.
Yeah. Looks very classy though. Congrats on that. So last one on business part, on market share, we have been very transparent there also in sharing the details there. So should we believe that the worst is behind in terms of losing market share, and we should somewhere bottom out here and then start gaining market share from here on?
The numbers are saying so, and we strongly believe that. I've always said that this is something that we would pursue very, very aggressively. But it's important to have the stance very clear that I am pursuing it along with making sure that we have sustained profitability.
Perfect. And two financial questions, if I may. Ma'am, have we provided for future group exposure totally in this year? And second, any update on the insurance refund which is waiting?
Future Group, the Big Bazaar piece was provided fully last year itself. So this year, what open exposure we have is on the FLFL, which is the central and the branch store. That also around 25% is provided. And on the insurance piece, we should get that in quarter. Sorry?
What would that be in absolute, the exposed unprovided number?
Should be around 9 crores.
Okay. Thanks, ma'am. You were saying about insurance.
Yeah, so the insurance piece is the last leg of final survey report, so we should get that in quarter 4.
Okay. That's all from my side, and happy Diwali to the whole team there.
Same to you. Thank you.
Thank you, Tejas. Happy Diwali.
Yeah.
Thank you. We have the next question on the line of Jinesh Joshi from Prabhudas Lilladher. Please go ahead.
Thanks for the opportunity. I have a question on exports. I mean, post-COVID, I believe that many countries are looking to diversify their supply chain from China. So in that context, which other countries can emerge as a probably alternative destination apart from India? And do we have any structural advantage vis-a-vis those countries like duty benefits, etc.? The reason I'm asking this is because our current export share is approximately 5% odd, but we plan to scale this up over the next couple of years. So any thoughts on that?
Yeah. So Jinesh, definitely we would like to scale it up going ahead. And there is definitely a huge opportunity. It's just not a duty or advantage that we are only looking at. I think being a good manufacturer ourselves, a cost-effective manufacturer would give us a right to success in markets which we are buying from China. So here, over a period of time, being competitive to China in manufacturing would be the key that would get us access to international markets. So that's what we are pursuing. As of right now, yes, we had seen some low-hanging fruits which we have initiated. But obviously, the bigger opportunities will be in the larger markets with US, Europe, Canada, and so on and so forth, where the higher quantum of luggage sale happens would entail. But some of these markets will be equally difficult to enter from a branded point of view. So I think it's too early for me to talk in any more detail other than what is the opportunity in terms of how we will go about it. Maybe once we are ready, we will I'll talk about how we are going to approach it, or when we have started approaching it, we will talk about it. As of right now, our strategy on international is to make sure the market we were present before, we go deeper into the market. For example, we've had a huge jump in UAE alone, where our penetration at a store level into all the modern trade chains have gone through a big change in the last 8 to 9 months post-COVID, and that itself has brought us a benefit good enough to get us a growth over our base, pre-COVID base, to almost twice, more than double our turnover in international. Very small base, but I think what I'm trying to say is that focus strategy, creating a go-to-market approach in a particular market and going deeper is working, and that's what we're doing right now, till we have reached to a stage where we kind of look at a wider strategy.
Sure, sir. The second question is on your gross margin profile. If I look at this quarter, I think we are at about 48% odd, and in 1Q we were at about 50%. So there is some erosion in gross margin on a sequential basis. But given the fact that raw material prices have subsided and the freight cost is also cooling off, can you give us a fair estimate of what would be the gross margin expansion in second half vis-a-vis what is the average number in first half? That will be of great help.
I will give you in the way you asked the question without giving. I can't give you specific numbers for the future, but what you said was absolutely right, that the cost, the raw material cost and the freight cost was possibly at its peak in quarter 2, and it is only going to go down from here. How much exactly in quarter 3, how much in quarter 4, where it stabilizes is a matter of, crunching the number. But I've always kept that, our gross margin profile that I would want to keep it is around between 50 and 52, and the aspiration is to make sure that we take it to 55 and hold it. But we would always want our ship to be within that, between these two guardrails of 50 and 55, and keep working on our market share and growth. Given this margin, we kind of try and bring it to that, within that, range.
Sure. One last question from my side. I mean, if I look at the brand-wise revenue mix which we have given this time around, the share of Aristocrat has risen from about 22% or to 37%, and the share of VIP and Skybags has declined a bit when I compare it with the pre-COVID days. Now, going ahead, given the fact that growth in the mass segment is expected to be higher than the economy or premium segment, I mean, does it mean that a rising share of Aristocrat from here on would essentially mean a lower gross margin profile for us, because essentially this product commands a lower margin? So just wanted to understand this bit from your side.
No, I think absolutely a right question, and the answer lies in the current gross margin also. So if you see, the table has shifted from 22% to 37% in Aristocrat's favor, despite the inflation that we are talking about now, compared to any base year that you want to compare. The gross margin erosion is not there. So therefore, this is what I was talking about, that we would like to play the value market share game in a manner that, we have done the cost reduction to fight this game better. So all our own manufacturing, upstream integration, all that is helping us towards this approach, where we would possibly increase the Aristocrat salience, which will help us gain market share, but it will not cause us to erode our margins commensurately.
Okay, sir. Thank you so much.
Thank you.
Thank you. We have the next question on the line of Nihal Jam from Nuvama. Please go ahead.
Yes, sir. Good evening. Am I audible?
Yes, you.
Yeah. So a couple of questions on my side. First, you've given the data of your increasing distribution versus FY20 in Tier 4 and 5 towns. Is it right to relate the improvement in market share and the consequent increase in Aristocrat and Alpha to that aspect, that maybe that's a key driver to these aspects happening of us increasing our top line in these segments and also increasing our market share?
No, it's one of the factors. It cannot be correlated 1:1. I think if you see our better traction in e-commerce would also help corroborate the fact that that's also selling a lot of value, and that also has a higher share of tier 2, tier 3 towns. So I think many factors comes together to make sure that value as a segment works for us. It's product, it is pricing, it is distribution, which is general trade, as well as distribution, which is accessibility, which is through e-commerce. So it's a mixed game.
Sure, sir. And just a related question to that was that, looking ahead, is your expectation that the value segment is expected to see a much higher growth versus the mid-premium and premium segments in the future? As an industry, I mean, not for you specifically.
No, so the industry has been growing more in the value side. And for the organized players, the value will grow faster going forward because of the unorganized to organized shift as well. So yes, value will continue to grow faster than the mid and the premium side.
Sure. Just a last question on Caprice. So there, our share is still, to come back to pre-COVID. What are the incremental drivers that will drive that? Because our plans in that segment remain very aggressive. And what are the incrementals we are taking to achieve that?
I couldn't hear the last part. Can you repeat?
Yes, in terms of Caprice, our plans are very aggressive. So what are the incremental steps we are taking now post-COVID in terms of, driving the share of that business or the overall top line in that segment higher?
There are several. Once again, from a product point of view, there is a lot that is up in store for us going forward. The presentation has some hint of what we are getting into in quarter 3. Also, from a distribution point of view, whether it is e-commerce, we are supremely active, and what we are activating now is physical channels as well, both in modern trade in chains like Shopper Stop and all the lifestyle chains, as well as some exclusive outlets is something that we are experimenting with right now. Largely, the mall kiosks and things like that. But these are all in the foundation stage right now, and what you will see us basis this, we will formulate something which is supremely more bigger and aggressive in the coming year, and that's where we will start seeing more aggressive numbers as well as plans.
That's helpful. Thank you so much, sir. Wish you all a very happy Diwali. Thank you.
Thank you. Thank you.
Thank you. We have the next question from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Yeah, thank you for taking my question and congratulations on good set of numbers. First of all, I would just echo one of the other participants' comment that thank you so much for improving the quality of your presentation quarter on quarter. So that really helps us in getting more understanding about the business and the industry. So my first question is in terms of as we see that if my understanding is right, Q2 is generally one of your from a relative perspective, Q2 is probably the worst quarter for you, right? And given the kind of maybe a point of some sort of pent-up demand plus some sort of like we are entering into the marriage season and all, I just wanted to understand how are we placed in the capacity front? How much of it is right now? What is the capacity utilization, and how easy or difficult or what time does it take to ramp up our capacity if required?
Yeah, no, I think it's a very valid question, and that gives me the opportunity to talk about that we are continuously investing behind increasing our capacity. As we speak, both in quarter 2 and now, we are putting in good percent of, good amount of money to increase our capacity in India, in Nashik, and in Bangladesh. We have just about now decided, I'm not talking about, the money, but we have invested to increase our capacity on our existing base by about 25%, which should help us cover for our growth next year. And we are continuously doing this exercise, and maybe early next year we would look at the subsequent year and continue to expand the capacities required. So this is something that is definitely on the radar, and it's happening as we speak. And we will ensure that we have the in-house capacities as well as our network of outsourcing as and when is required is more than the demand that we are envisaging for ourselves.
Thank you, sir. And next question is on one of the slides, I think slide number 33. So where we have mentioned about the market share of VIP against the other two organized players. So we have mentioned about till Q1 FY23. Is it fair to assume it is at the similar level in Q2 as well? Or it has made some changes there?
No, see, that's the difficult part to estimate, and I would be doing a projection here. But given that sort of result, I am hopeful that if not gaining, we would hold it at this level.
So just a follow-up, sir. So, if you look at pre-COVID levels, we were around 50%, and post-COVID right now we are at 43%. So how do we look at it? And
I think that 50% is an aberration, right, of that particular quarter. If we look back in the previous quarters, it's hovering around 45 on an average for a year. So I think a rightful share and where I would want this organization to be at is that of 45% plus. And having done that share in luggage, I would like to make sure that we focus on newer and more, our growth areas, which are more in the adjacent areas, which adds more, more faster top line growth and overall business growth.
Right. Sir, and when you spoke about in one of the other participants' question that the unorganized to organized shift, like what we witnessed during the COVID period, as in the unorganized sector was hit far more hard compared to the organized sector because probably because of the strength of the balance sheet, if I'm not wrong. Now, if we say something like we are hearing about a recession in US and UK. Right now, India continues to be looking at strong demand. But say if we get something like that in India as well, or some jitters in India, is it fair to assume that again during this period also the unorganized sector will be hit harder than the organized sector, or do you have some other view?
I think there are a lot of scenarios within which you're building, but underlying thing is that yes, in the future the environment for unorganized sector will not be as conducive as it was in the past, and I think the change started happening more from the GST. The COVID and the China situation made it more acute. It will possibly ease out a bit from where it was the worst situation last year, same time, and even now. Maybe it will ease out a bit, but really speaking, pre-COVID and going forward, I think there will be a different scenario where the organized player, for various reasons, will have slightly more advantage than what it had before COVID.
In that sense, do we expect more new competition entering the sector, and how do we look at, apart from the top three players, incumbents, do we look at more competition in the organized sector, and how do we look at that space in that sense, from the competition perspective?
If you look at globally, I think the biggest player is here, and there has been some consolidation that has happened. So, really speaking, there are not really large players outside the country who's yet to enter India. So therefore, yes, there will be, and this is a place which is, barring the top three players, the list is really long. It's quite fragmented. So there is endless list of brands and players that is there, and there are continuously many coming because the entry barriers are not that high. So that always have been the case and may continue to be more. But to that extent, unless you have a proper supply chain, it is not as easy today possibly to come out, because it's not that you go out and buy some products and you can create a brand and launch it in this thing. You will need to have a little bit more structured approach for a completely new entrant to enter the category in India. So some bit of discouragement maybe, but largely it's a fragmented industry, and I expect smaller, newer competition to continuously keep attempting or entering the category.
So one last question. As you mentioned earlier, that the value segment is growing much faster than the other segments, and one of our competitors is predominantly present in the value segment. Are we also trying to focus more on that, or we continue to have our strategy of focusing on all the whole range of brands which we have?
No, absolutely. The second one, as you said, we are obviously keeping all competition on watch, understanding what they're doing, understanding their strengths and the opportunities that we have in the market in terms of where we could kind of pursue something against competition. But largely we are governed with our own agenda that we have built, and our agenda comes from what opportunities we have with consumers, how can we service consumers better, and that's the starting point, and everything else follows from there.
Thank you so much, sir, and all the best for the rest of the year, and happy Diwali to all of you. Thank you.
Thank you, and same to you.
Thank you. We have the next question from the line of Harsha from InCred Capital. Please go ahead.
Hi, sir. Hi, ma'am. And first, thank you for that. Look in between margin and market. So basically, this quarter you kind of recorded very good number on top line. And last quarter you did kind of mention that you have an aspiration of 80 EBITDA margin in the second half of the year. So my question was that
We can't hear you. You're not audible. Your voice is
Question to the
breaking.
participant. Mr. Shah, if you could kindly come closer to the mic.
hello, can you hear me now? Am I audible?
Yes,
Hello.
you're audible a bit now.
Yeah. So basically, my question was more about the interplay between margins and market share. So if you were to look at this quarter, we have done fantastically well in terms of top line. But however, in last quarter we did talk about an aspiration of 15 to 20% EBITDA margin in the second half. So, so how do we look at that piece, right? Do we kind of, how do we look at an interplay? So, do we change market share, or do we have a hard target of achieving that 18-20% margin?
So I think we need to see the margins with a slightly longer period in mind for the full year. And I think from a strategy point of view, in way we are pursuing both market share and margin, we have a good balance in our mind how we are pursuing. And I would repeat again that we are trying to find the ammunition to fight the market share game, and that is not profit but cost reduction, and that's how we are inspired. That's how our agenda is. Now, in this quarter, you are right, this is our peak inflation quarter, and it's also by seasonality our lowest revenue quarter. Therefore, absorption of that revenue across all costs is lower, and so on and so forth. So I think the ambition of 18 going up to 20 continues, and that's something that we will keep driving. There will be one-off quarter where it will not be on those lines, and therefore some other quarter we possibly will make up to get the year to be at that particular number. That's what I would like to position ourselves as.
Okay. So, sir, basically the priority is on gaining market share, right? If you were to, prioritize between gaining market share and achieving the margin target, we will say priority is to gain market share, right?
As of today, if you have to, if you ask me to choose only one between the two, as of today, yes, it is market share.
Oh, basically, a higher market share with a different level of margins would be better than having that.
You're right. Gaining higher market share while maintaining profitability is what one would like to deliver.
Okay. Thank you so much, sir, and happy Diwali to you and ma'am.
Thank you.
Thank you. We have the next question from the line of Jayveer Shekhawat from Ambit Capital. Please go ahead.
Sure. Thanks a lot for taking my question. Good evening, gentlemen. Firstly, can you tell me the volume recovery versus the pre-COVID levels, and also how it would be across, say, your value, mass premium, and premium segment?
Volume recovery was also pretty good. Underlying volume growth was about 13-14% overall for the category in this quarter over the base quarter of FY20. And obviously this was like the value trend is showing, it is more higher in the value segment than in the mid-premium. But overall it's about 13%, 13.5%.
Got it. And given the amount of revenues that you've achieved already in second quarter, would you update your revenue guidance of about 2,000 crores for FY23?
What do you want? Yes, I don't see any reason why in the remaining quarters it will go down from the guidance that we had earlier given. So whatever has happened till now should stretch us to that limit. But yeah, I'm not fixated on the number, but directionally it is getting better from what we started the year with, for sure. It could be even better than that.
Understood. And sir, any update on the Walmart contract you would like to share about?
I am not very sure where this is coming from. I have not spoken about this. Which Walmart contract are we talking about? This has actually had come as a question somewhere before also, but is there a reference to this?
I think this is what we have picked up from our channel checks itself, but would you have any update about, say, any negotiations that are already underway?
No, there is nothing much to talk about there. We are obviously in our, from OEM point of view, we are interested in possibly taking up a few, but it has to be only the larger accounts are bigger. That's how we are seeing it right now. And in that context, one of the illustrations or example could be Walmart. And the team is in touch with various across, not only them, but across many other such larger potential customers. But that's about it. There has been no discussions beyond that which is worthy to talk about here.
Sure. And sir, one more question on your margins as well. I understand what you've guided in terms of your gross margins, where you would like to achieve it. But say, given what we have seen with the crude oil prices happen as well, so they have corrected from as high as about $120 per barrel in June to about 90 currently. So purely from a RM pricing standpoint, what kind of a GM expansion should we expect in the coming quarters because of that?
I think he already answered that question, right?
It is positive. I can't tell you an exact number, which is what is happening, but I think it's also important to see, there is a cycle in which we buy our raw materials, especially for soft luggage and all other components, which has a lead time, which makes any benefit or inflation that happens today result into the business at a time later than next 3 months or 5 months. So to that extent, if there is something reducing right now in the environment, we will not get the benefit in the immediate quarter. So that's where we are. So yes, when that reduces, eventually that will flow into the business in maybe in 5 to 6 months' time.
And so, were there any price hikes further post the March hike?
No, absolutely no.
No. Is that because probably customers are not willing to absorb further price hikes, or do you see no need to do that?
We didn't see any need. We had a strategy which we put in place in terms of our pricing and the cost reduction that we wanted to do within our operations. So, and we are on track with that. So it's moving on the plan. So we don't need to react in any way as far as consumer pricing piece is concerned.
Mr. Anandya, if I may just sneak in another question on Uppercase. I mean, we have looked at the new launches that they've done, so looks quite fashionable, and also their 2,500-day warranty and very attractive price points for soft luggage. So what's your reading of the situation? I mean, do you see the e-commerce space getting more intensified?
Undoubtedly, I think e-commerce just makes the accessibility to consumers really easy and fast. You got to spend a lot of money. If you burn cash, you will be able to get not only eyeballs but also transactions. So that's definitely something that we are watching out on, whether it is Uppercase or players like Mokobara, or there are many such players who are spending money with a range that is listed on the marketplaces. So we give it its due importance, and we are tracking it and making sure everything that we need to do to benefit our cause, we are taking those actions.
Sure. Thanks a lot for answering my questions. Happy Diwali.
Happy Diwali.
Thank you. We have the next question from the line of Ankil Parekh from Centrum Broking. Please go ahead.
Hi, this is Akhil here. Thanks for the opportunity. Sir, first question is...
sorry, you are not clearly audible.
Better now?
Mr. Ankil Parekh, if you come on your headset, it will be better. Your voice breaks up in the between.
Is it better?
Yeah.
Yes.
Okay. So my first question is, in the other consumer categories, what we are observing is, right, the value segment is struggling while the mid-premium, premium segments are doing well, while on the contrary in luggage over last few quarters, the trend is the other way around. So my question is it because the unorganized segment is struggling from a standpoint view of supply chain issues, and that's why the branded players, including us, are gaining market share? Or is it the brand salience of the organized player is organically actually growing over last few quarters, and that's why the market share gains have happened from unorganized to organized?
No, I think what we need to understand when you're comparing with any other category, the penetration of that category in India today. If it is highly penetrated category, then it's very different from our industry and our category where the penetration is not there. And as and when more new consumers, first-time buyers, non-buyers for many years, as they come in the lower economic strata, as well as the lower town classes and all that, I think that is what is driving growth for value for money product range in this industry, and that is possibly bigger a source of growth than this whole unorganized to organized. So that is growing, and adding to that for the organized player, the shift of unorganized, which is not able to meet that consumer demand with the same economic advantage that the unorganized sector used to have before. That is yielding into the organized player. So I think the underlying source is penetration that is increasing in India, and that therefore it is not temporary. It is going to be sustained for a good amount of time going forward, because luggage as a category compared to many other categories not that penetrated. The usage of this, let's say in a middle class household, is largely when it is an occasion like a marriage and all that. The travel in India, occasional holidays and all that is prevalent at a certain economic and a certain social strata and above. Now that's, as India is becoming more and more prone to indulge itself in, traveling, more spending in marriages and all that, kids going out of their homes and studying in other cities, these are the bigger drivers which will drive the consumption of travel products and things like luggage and bags, and that's the big opportunity continues to become bigger as an opportunity going forward.
Sure. So this is helpful. So essentially what we are saying is probably this trend is more sustainable and might not be kind of a one-off thing.
Absolutely, and could be better than the overall category and industries that you are comparing with. This may have, when you compare, categories across what consumers use, this will possibly have a more sustained growth overall for the industry than comparable or other categories.
Got it. And the mid-premium segment has started to, started seeing good traction. So is it correlated with the late opening up of international travel, and that's why we are seeing more traction now?
Yes, absolutely. And not only that, overall, I think this segment has started a little late in terms of the leisure holidays and buying of products after that. So this is definitely very, very robust right now in terms of this consumer segment starting to spend on travel and all other consumption cohorts that we cater to. There is an underlying demand which was always there. It has just got activated, may have got activated with a little bit of delay than the value or the other part of the category.
Got it. This is helpful. The second question is on the international market.
Parik, would you wish to kindly come in the queue for follow-up questions?
Oh, sorry.
We have the next question from the line of Jignesh Kamani from GMO. Please go ahead.
Thanks for the opportunity. Just on the annual sales, so last year it was mentioned that close to 180 to 200 crore was the selling because of the COVID and everything. And out of the close to 100 crore is sustainable, which goes down 25 crore quarterly run rate. So just wanted to, what was the actual quantum of selling this quarter and the other quarter?
Sorry, I don't think I'm able to follow you.
Yeah. So it was mentioned, guided that close to 100 crore annual saving is possible because of the COVID related, you can say, all the cost control, which is permanently sustainable. So which is 25 crore and quarterly saving. So what was the actual saving happened in this quarter or the first half? Because of all the cost control exercise which did last year.
You're referring to 100 crore. I think the calculation and leading it to this quarter, we might find it difficult to answer exactly in what we're saying. But I think we need to understand in a way that whatever cost reduction we did with one stroke when COVID happened, and we said some of it will come back when business come back. I think that has come back, and whatever we said at that point of time, we would not let come back, whether it was headcount or some structural costs like offices and rentals of exclusive business outlets. All that has not come back. And those are the numbers I was sharing, that we have not added, while our total EBOs have gone up from, just one second, I'll give you the
413.
Our total EBOs have gone up from, let's say, 365 to 413. only 4 has gone up in company-owned stores. Rest everything has gone in franchise. So this is just an illustration of the fixed cost in rentals has not gone up, and therefore we have retained it while the business has come back, and the exclusive business outlets is throughputing now a growth over even the base year.
Because if I take about 25 crore annual savings from 2.5% of the quarterly EBITDA, but we are not able to see the improvement. So advertisement spend has increased drastically, which has taken, I can say that saving has been taken care by that, or how is the scenario?
No, I think comparing at a static way of the cost, right? The cost also is going through an inflation, whether it is people cost, manpower cost, and all that. So it's not an absolute of 25 crore that can be compared like that. Yeah.
Understood. Sure. Second question on the supply chain side, how is the number of SKU, I can say, in the range our Bangladesh factory is able to manufacture right now versus earlier? Because in past we had an issue where that because of limited supply chain at the Bangladesh, we lost some of the revenue, I can say, in India.
Absolutely not. Bangladesh is able to make not only all the SKUs, but our Bangladesh facility is making all the 5 category of bags that we are in, whether it is hard luggage, soft luggage upright, backpack, duffel bags, and as well as ladies handbag. So in a short period of about 2 years, we've been able to increase the Bangladesh operation not only in total volume but also in terms of its capability to produce all the categories that we sell, and therefore with the categories comes designs and SKUs. So there is now it's come up to the level what we wanted it to be in terms of its capability. Yes, but as and when we innovate more and more, the number of SKUs and complexity keeps going up, and that is a challenge that would be there in any manufacturing sector, and therefore there is nothing.
Last question is, still we are importing trolley, right, from the China?
So would request you to kindly come with follow-up questions in the queue.
Okay, sure. Thanks a lot.
We have the next question from the line of Madhuchanda Dek. Please go ahead.
Yeah, hi. I have a couple of questions. One is, as you rightly pointed out, some of the secular trends like people traveling more, marriage, etc., discretionary expenditure, which is benefiting luggage, coupled with this trend of shift from unorganized to organized. Given all these pieces, putting all these pieces together, what is the expected normal trend of growth for this industry beyond FY23? Because FY23 will have a little bit of this pent-up demand, etc., etc. So not really the number to look at from a long-term perspective. So, but for a long-term perspective, for the next 5 years, what is the kind of growth rate do you see for this organized industry? So that's my first question.
Okay. Well, there is always an element of projection and an assessment of overall economy, how it is growing. It is dependent on the macro situation in the country. But if I was to keep that variable aside, I think getting to about a 15% CAGR over the next 5 years for the industry is definitely a definitive possibility. And I would think it should definitely continue to grow at that rate and maybe a little bit beyond. And this I'm talking about more the luggage segment. I don't think we have a full understanding from our side right now to talk about the whole women's fashion accessory or ladies handbag at what kind of growth rate it will have. But more from luggage and backpack, I think this is where we are looking at an industry to definitely grow at.
And you and efficient players would have some edge, over this growth rate, right? That's a correct understanding.
That's right. That's right.
Yeah. I have just 2 other housekeeping questions. One is on the capex. What is the total capex plan for FY22 and FY23? And where would your own manufacturing stand? Sorry, not FY22. I stand corrected. FY23 and FY24. And where would your own manufacturing stand at the end of fiscal 23 and 24?
So I will tell you about FY23. I think it will be in the order of magnitude 100 crores in terms of capex. And purely own manufacturing, we are hovering around 65 odd percent till beginning of this year, and I think we will end up at about 70-75% by the end of this financial year by FY23.
And any outlook on 24?
Too early to say. We will work out the plan, and as I said, the capex will be a resultant of the growth that we are going to target, which would be quite healthy and robust, and therefore what part of that we would like to produce ourselves and what kind of investment would it need from, obviously plant and machinery is one. It could mean facilities and buildings and all that. So when we get there, we will kind of have our number. We're not in a stage to talk about it right now.
Okay, thanks a lot. All the best, and wish you all a very happy Diwali.
Thank you.
Thank you, and same to you.
Thank you. That was the last question. I now hand the conference over to Ms. Neetu Kashiramka from VIP Industries Limited for closing comments.
Thanks everybody for joining the call. Happy Diwali. In case of any questions, you can connect with us anytime. Thank you so much.
Thank you, and happy Diwali, everyone.
Thank you. On behalf of VIP Industries, that concludes the conference. Thank you for joining us, and you may now disconnect your lines.